in this week's market update, a plunge in the oil price unsettles broader equity, bond and currency markets. Rishi Sunak prepares his first UK budget, and Joe Biden looks to build on his Super Tuesday success. Financial markets suffered their biggest falls on Monday since the financial crisis, as a plunge in the oil price and growing coronavirus fears combined to send investors running for safe havens. As is often the case, they then staged a partial recovery on Tuesday, as some braver investors decided the sell-off had gone too far, too fast. The price of Brent crude fell 30% at one point on Monday morning after Saudi Arabia triggered an oil price war following the collapse of talks last week with fellow production giant Russia. The two had been grudgingly cooperating for some time, most recently to counter a sharp drop in demand for energy in the wake of the coronavirus outbreak. But talks broke up without agreement on Friday, as Russia decided to pull the plug on a strategy which it worries is actually just supporting its rivals in North America's shale fields. Russia's refusal to support a cut in production by OPEC pushed the group's de facto leader Saudi Arabia to promise higher output and bigger discounts to cut the price of the globally traded commodity. The move is high risk. It punishes Russia, which is dependent on oil sales. The move is also calculated to hit the North American shale industry, which has swamped the world market with excess oil in recent years. But Saudi Arabia is perhaps more dependent than any country on a high oil price if it is to fund the planned modernisation and diversification of its economy. Trading in Saudi Aramco shares was suspended after they fell by the maximum allowed 10%. Riyadh's threat to flood markets with oil sent the price of Brent crude as low as $31 a barrel. The US WTI equivalent contract fell to $27.70, although both bounced back on Tuesday. The dramatic fall in the oil price hit the energy sector hard, with bellwether stocks like BP and Shell losing a fifth of their value in chaotic early trading on Monday morning. Some smaller exploration stocks fell even harder. But the biggest victims could be North American shale producers, many of whom have borrowed heavily to fund their activities and may struggle to survive a sharp downward price shock. The pressure on energy stocks spilled over into the wider markets, with massive falls across Asia, Europe and then America as Monday unfolded. Hard hit were the banks, which stand to lose heavily if struggling energy companies default on their loans. From Tokyo to London and then New York, shares fell by as much as 8%, with a plunge on Wall Street triggering a 15-minute trading halt soon after the dealing day began. Investors fled shares in search of safe havens. As usual, they alighted on government bonds, pushing the US 10-year Treasury bond yield ever closer to zero and a new set of record lows. The 30-year bond yield fell below 1%, taking the yields on all maturities of bond below this level for the first time. Expectations are now high that the Federal Reserve will move to cut rates again following last week's unsuccessful 0.5 percentage point cut in US rates, which tried and failed to stabilise markets. As well as bonds, investors have moved into traditional safe haven currencies. The Japanese yen rose by more than 2% against the dollar, while the currencies of oil-exposed countries bore the brunt of selling pressure. The day had started with heavy selling of shares in Japan, down 5.6%, and Australia, 7.3% lower. By the time trading had opened in Europe, markets were in turmoil. Many stocks took several minutes to even begin trading, up to half an hour in some cases. The Italian MIB index was hardest hit, down 10%, as the country remains the focus of coronavirus concerns in Europe. Over the weekend, more than 16 million people in the most prosperous north of the country were put into lockdown in a bid to control the outbreak. The Stoxx 600 index, which tracks the region's biggest companies, has now fallen into bear market territory, meaning a drop of more than 20% from the recent peak. In London, heavily exposed to energy stocks, shares fell by 8.5% at the open, as the oil price fall triggered a widespread capitulation by investors already reeling from 2 weeks of coronavirus-fueled nerves. The FTSE 100 index traded at 7,675 as recently as January the 17th, since when it has fallen by 22%, plunging it too into bear market territory. It fell below 6,000 yesterday for the first time since early 2016. Before this, the UK benchmark had not been in the 5,000 range since 2012. Markets rarely move in one direction for long, however, and sure enough, Tuesday saw some respite. Brent crude rebounded 8% to $37 on Tuesday. The Chinese stock market recovered by 2.1% and Tokyo was up 1.3%. The FTSE 100 added 3% to rise above 6,100. Havens fell out of favour with the 10-year Treasury yield up 21 basis points to 0.7%. The yen weakened by a couple of percentage points against the dollar. Now, the collapse in share prices sets a difficult backdrop for Rishi Sunak, the newly promoted UK Chancellor of the Exchequer, who's due to unveil his first budget tomorrow, Wednesday. He was already acting in the context of the biggest public health crisis in generations, with many fearing that the coronavirus outbreak is poised to inflict significant damage to the UK economy. It's already coping with the uncertainty of ongoing Brexit negotiations. The competing pressures on the Chancellor may mean he chooses to limit his ambitions, deferring big decisions on spending and maybe pension reform until later in the year, when a second budget and a spending review are scheduled. Attention will focus on government growth forecasts, which are more out of date than usual, thanks to the lack of a budget in 2019. And they're open to even larger revisions than usual, thanks to the many uncertainties clouding the economic picture in Britain today. The UK government is keen, though, to finally put an end to 10 years of austerity, and it had been planning to open the spending taps in a bid to invest in the left-behind parts of the British economy. But those ambitions may be overshadowed this week by the need to support the economy through the possible pandemic ahead. Meanwhile, away from the markets and the economy, the two-man race between former Vice President Joe Biden and Bernie Sanders to win the Democratic Party nomination heats up this week. Having unexpectedly emerged as the front-runner during last week's Super Tuesday round of primaries, when a third of delegates were at stake, attention now shifts to a handful of other key states. If Biden can build on last week's gains, then Sanders will have a mountain to climb to get approval from Democratic Party members for his socialist agenda. In more normal conditions, that would probably get a nod of approval from Wall Street, but any relief has inevitably been drowned out by everything else going on in the markets. Also somewhat lost in the noise will be this Thursday's ECB meeting, when further easing is now expected as the European Central Bank looks to join in the global response to the market's twin crises.